Welcome to the Daily Update, where I'll go over the action in the market from Monday, May 13th, and then we'll see how things look for Tuesday, May 14th. It was a pretty slow day, and not really a surprise. We have some major economic reports coming out throughout the week. We're going to get PPI on Tuesday. We're going to get CPI and retail sales on Wednesday. And then later in the week will be industrial production and capacity utilization. And we'll have to see, is that going to change the whole scenario that's been developing? This started a couple of months ago with CPI coming in stronger than expected. We also saw that a month ago, where instead of inflation coming down, it's actually turning and going back up. Is that going to be what happens in this report? How is the market going to react to that? We're still looking positive for the time being across all the different time frames. Usually when we're in a solid uptrend and we get to an extreme positive condition, which is where we've been at now for a number of sessions, we can stay there for a while. It just shows good momentum. It's when we're in a downtrend and then we see a counter trend move and that becomes extreme positive. That's usually when we really have to pay attention, and it looks like we could be showing a pullback, if not an outright reversal. So for right now, things are still looking positive. There's always some things to be concerned about, including I have an announcement to make here, and I'll just put all the information up here. As of June 3rd, that'll be a Monday, for Monday's video, I'm going to be locking down the daily videos, which means they're not going to be publicly available. They will be available after the close. So for Monday's session, it'll be available after the close on Monday. About half the people that watch these videos watch them after the market closes. I've been doing this for a few years now, and this idea was to promote the program that I have, and I'm starting that program in June. And so part of that is that members in the program have access as part of their monthly membership fee of $97. They get access to videos right as they're available. Now, if you don't want to be in the program itself, but you do like having early access to the daily videos, they will be available for $19 a month. That's about $1. I do 20 daily videos every month, so that's a little bit less than $1 a day. Please offer any feedback that you may have, either positive or negative. This was part of a bigger picture plan that I've been trying to unfold now for a couple of years, but a lot of you really gotten used to the idea of watching the videos every day and just having them there. And if it's really a deal breaker for you that you have to pay for that, well, let me know how you feel about that. If you think it's fair, I could charge a lot more than that because I spend many hours preparing every daily video. I enjoy doing it, so I'm not like, oh, woe is me. But I do feel I need to be compensated for my time. I was willing to do this for free as it was more of a promotional thing to kind of build my channels, both on YouTube and Rumble. Now I need to take that to the next level for myself and some of the things that I want to do in the program. And so it looks like June is when that is likely to happen. So just be prepared for that. And I'll be making an announcement, probably not as long as I am right now, because this is the first time I'm announcing this, but I'll just say this in every video up until that actually happens. All right, let's go back and talk about what happened right at the open. We did have a higher open, but prices hit resistance right at the open. We didn't quite get up to R1 at 52.38, but that set the high for the day right there. Then we declined down to the daily pivot at 52.24. We got down to the unchanged level. As the day went on, we just chopped above and below the unchanged level. We were drifting a little bit lower. The market started to go up a little bit higher, but then we hit resistance at the daily pivot. And then we ended up closing near the end of the day slightly negative. So it still goes in the books as a negative day, even though it was virtually unchanged. And we're still below average with volume. Now, last week, that's been a concern that I was noticing. We were going up with the S&P, but volume kept getting lower and lower and lower, which is a classic warning sign, in my opinion. That's not really a surprise in Monday's session. Ahead of these major economic reports coming out, for folks to not want to get into big positions or maybe even any positions ahead of those reports just shows that they're being a little bit cautious right now. We are positive in the short, intermediate, and long term, and even the weekly video. Things look quite positive there. It's all about inflation and interest rates this week. What are the inflation reports going to say? And then what are interest rates going to do? And then what is that going to do to stock prices? Send them higher, send them lower, or are we going to end up more cloudy where things aren't really clear and kind of chop along the way we can do sometimes? We do want to keep an eye on the geopolitical events. They don't really seem to be having much of an impact on the markets, but that can change at any time. Some comments. Volume still continues to drop. As I said, for Monday's session, that's not really all that big of a shocker. But to see it go down last week, that is a concern. On a short-term basis, we still have the Stochc RSI, the Williams percent R, CCI 14 and 20, the stochastics, and the slope oscillator. They are extreme positive, which because we're on a longer-term uptrend, you could, for now anyway, until things start to shift more negative, you could just say this is showing good momentum. In the intermediate term, we have the CMB composite, which is the third or fourth day now. We usually don't see it extreme either up or down that often, but it's still hanging out up there. And the Sean trend meter can still go higher than where it's at right now, but it's starting to get more into that extreme territory. And this has been this way for pretty much all of 2024. We're still looking extreme with the 150 and 200 period simple moving averages. And here's the scenario that hopefully will change this week as things become a little bit more clear, that the Fed is probably going to leave rates unchanged, at least at the next two meetings. That's what the probabilities are suggesting right now. But that can change. These probabilities change every day. And the reason for that is inflation has become stubborn or sticky, as they call it. It's not coming down to that 2% level the way the Fed wants it to. It's actually turning and going back up. And so that's kind of ruined that Goldilocks scenario that we were in. And if they do any rate cuts in 2024, the timeline is pretty uncertain, which could be quite negative because there's a lot of banks, there's a lot of businesses that were planning on rate cuts happening in 2024. And if those don't happen, that could end up causing some problems. But what's been helping the market lately is the Fed is back in and they're decreasing QT, which means they were letting things drop off their balance sheet. They weren't trying to prop up the economy by going in and buying things. Well, since they're decreasing that, they could be coming back in and actually doing some buying. The market likes that. And that was part of the catalyst for things showing some improvement after the Fed meeting. The dollar was down and interest rates were also down. We closed at 4.48% after Monday, where we had been at 4.5% last Friday for the 10-year yield. We're still inverted with the yield curves. We're positive with sentiment. We came in right at 50, where we had been at 48. We're still not trending. We're positive because the green line's on top, but the ADX is declining. It's below 20, and it's also below its moving average. Now, if we get some kind of a move, it's trying to turn up just a little bit, and you'll see that when I show the chart, but it hasn't crossed above the moving average, let alone 20 at least yet. For right now, I just kept the bias at positive because it was virtually an unchanged day, and the momentum over the last number of days continues to be positive. We didn't have any economic reports on Monday, so there's no charts to show you. So looking at this, and I know it's a bit fuzzy here, but I have to blow this up like 400% just to see this chart down on the bottom. But it says another buying thrust supports the bulls. This is what happens after there are 3 consecutive days. Now, this is what does the S&P do after we've seen NYSE advancers of 74% or greater. That should have triggered a Zwag NYSE breadth thrust. And we did trigger one. It was just a day late. And you can see down here the results: 1 month, 3 months, 6 months, and 12 months out. The further you go out, the higher the percentage that we're actually higher at that point. And then you get the median and average returns. So it's a positive thing to see a real upthrust in volume the way we have. Looking at the legal insider transactions ratio, we're still kind of in neutral land right now. And now when we get this chart, I also show the next one. This is an ETF. It's an insider buying ETF. And it's been going back up. It hasn't quite been able to get back up to its 50-day moving average. And then central banks turned into net gold buyers after the great financial crisis. That's back in here. because the gold is usually seen as an inflation or a hedge against insanity, not just inflation. Well, now they're still buying a lot. It has dropped off a bit here, but we're seeing an awful lot of buying by central banks, and that has really propped up the price of gold. Yeah, the consensus expects the pace of core CPI inflation. You know, when they take out the things that you really need, the food and energy, that's core CPI inflation. And they think it's going to come down according to Goldman Sachs. If they're right, this could be very bullish for the market. If they're wrong, that could be very bearish for the market. And then here's some price targets put out here. Who is this? Morgan Stanley, right here, where we have the base case. That's the way things are at right now. They see earnings for the S&P 500 at $266. If we go up to $289 and keep a multiple of 17.5, yeah, right. Like that's going to happen. We're already above 20. Well, then that would give us a price target of 5,050, and we're well above that right now. So we would have to decline 1.5% just to get to their target. The base case here is $266 at a PE of 17. That would get us down to 4,500. We would have to decline 12%. If it turns bearish, like it hasn't already, according to this chart, we go down to $234 for earnings and get a PE ratio of 16.5. That would take us down to 3,850. Still could happen, but at the same time, things are when we look at our other charts of earnings projections going forward, it's still a straight up red arrow. Then a couple of charts here that I found. JP Morgan maps out the game plan on CPI day. Okay, and I'm not going to read through all of this. You might want to pause the video and just look at this. What is the reading going to come out as on a month over month basis? And the probability, they think it's going to be between 0.3 and 0.35. If that happens, we're going to be down 0.5% to a 1% gain. I mean, yeah, okay. It's like it's going to be somewhere between 0 and 100. Yeah, it's like, okay, these aren't really projections at all. They're just throwing darts between into a very wide range, or target, I should say. This is interesting here, and this could have an impact. Small caps have relative bigger share of debt concerning what's coming due. And this is what I've been talking about. When interest rates go up, this really pressures the small caps. And going back and then projecting forward, you see where the S&P 500 right now, it has more debt. But that tends to change over a period of time, especially looking out into the future. And if some of this debt has to be refinanced at higher interest rates, that could really hurt some of these small cap type companies. And where it doesn't seem to have as much of an impact on S&P 500 companies. They're bigger, they can absorb this a little bit easier. Then, of course, I spent a little bit of time going through my perma bears over the weekend. And one perma bear that I don't pay anything to get the information from this person, because he says the same thing all the time. Stocks have an Elliott wave arrow going down and gold has an Elliott wave arrow going up. I mean, that never changes. Hasn't changed in over 20 years of following this person. But he's having a free week. And I don't want to mention his name because anytime someone disagrees with him, he's like, I'll see you in court. So he's one of those kind. But this was taken out of a free week that he now has available. And it says the big picture situation remains the same. It looks most probable that the stock market recently declined in its first wave down of what is likely to be a lengthy and deep bear market. He's been saying that for 20 years. No matter when we go up, we have a little bit of a pullback. And here we go. This is the big one. It is highly probable that the stock market has finished Elliott wave topping patterns. So this is one reason I don't use Elliott wave. You have to put your own subjectivity into this. And for whatever reason, he's a very negative person. And so no matter what the chart is actually doing, no matter what the evidence is, he always comes to a doom and gloom decision or conclusion. And of course, then these topping patterns, rising bear wedge topping pattern. That's one of the reasons I don't use these patterns. And I mention that quite often is you have to, you could see it one way, I could see it another way, but we're looking at the same information. All right, then there's another one. This is a little more optimistic. Looking back to February, I discussed my expectation that the market rally would persist until July and possibly extend into October. Now, this is not a perma bear. This is somebody who I consider to be more realistic. That when we're going up, okay, yeah, here's the evidence that we're probably going to keep going up. If we're going down, okay, here's the evidence that we're probably going to keep going down. So this is more what I like to be. Especially given that this is an election year, which tends to be positive. I still anticipate a bullish summer rally. And seasonally, that's what we see. We don't know if it's going to happen. And nobody can say with any dogmatic conviction that what is actually going to happen. And people come up with their opinions. I think this is going to happen. I think that's going to happen. Okay, fine. My approach is to just look at it day by day by day and then just evaluate things as they come out. All right, let's go back and look at the chart. Not an awful lot to show. We saw the high right after the open. We almost got up to R1, and then we just danced along the unchanged level in daily pivot. We came just about back up to the daily pivot to close. Here's our intraday chart. Not an awful lot really to show there. We still see where the blue line is above the red line. So growth is outperforming value on an intraday basis. That's holding up. It's not holding up on our end of day charts. And we're pretty much flat here with our intraday look at S&P growth to value. We were unchanged with growth with the large caps where we were down with value. We were down with the mid caps compared to mid cap value. And we were up, but up a lot less with the small caps. So looking at our end of day charts, we're still going down with the small cap ratio, the mid cap ratio, and the S&P ratio. This is also starting to come down. It was actually up just a little bit, but we had come up to the top of the rainbow. We fell back, and this ticked up just a little bit according to these two ETFs. Discretionary, not really giving the market an awful lot of support right now. Large cap growth was unchanged on the day, so nothing was decided there. The Wilshire was down fractionally, so it's been looking a lot better. This is a broad market measure. Looking at our trend, we're still below the moving average, and we're still going down, and we're still below 20. That shows a non-trending environment, but the green line is still on top, even though it ticked down just a little bit. See, this is one of those indicators where when we have a down day, that's when this counts it is either positive or negative. Short term, trying to turn up, but have not come back above the moving average yet. We're also showing the green line on top, but a non-trending environment. And we continue to drop off with volume. The hope is that that will pick up as these economic reports are released. Sentiment, this is a chart that we look at once a week where it's very different from what we're seeing with our usual charts, where we're coming in at 68.22. It has come down a bit, but this still, I would count this as positive, where they're seeing it more as greed. The Ulcer Index is still kind of flattening out, but underneath its moving average. We don't have a reading yet for the Investors Intelligence, but the last reading was neutral. And we turned up here with the VIX, both with the line chart and the bar chart. In the what to watch video that I did over the weekend, I really focused on the VIX because we're seeing some very low readings there that could end up making the market vulnerable. So we're ticking back up with the VIX of the VIX also after getting very, very low readings here. But the momentum of the VIX continues to be down, even though the VIX ended up being up a lot more than the S&P ended up being down. And this is kind of a variation of the chart that I show in the weekly video. This shows the spread between risky and not as risky bonds. When this is going down, that means the bond market is not anticipating a lot of fear. And this could produce some kind of a bottom at some point where the next move might be up. Just something to keep in mind. And then we look at credit spreads, the chart that I just showed you back here, and then we compare it with the VIX. And these two have a real strong tendency to go in the same basic direction. The equity put call ratio turned down a little bit on the daily chart, and we're still declining with the 5-day chart. So that's still positive for the market. We're turning back up just a little bit with the volatility risk premium. Could be some maneuvering ahead of these economic reports coming out. We ticked up a little bit with this fear gauge. We continue to tick down slightly with this other fear gauge. We're still looking okay here with the advanced decline line. We're coming back to this previous high, but we haven't necessarily set, in fact, we haven't set a new all-time high for the S&P, showing a little bit of an improvement with volume, but it's still lagging just a tad now. The new highs, new lows, they did drop off in Monday's session, but they're still looking positive overall. Our 5-period and 10-period are still going up. The advanced decline ratio ticked down a bit, but it's still positive. Accumulation distribution declining a bit, but still above the moving average. And the Chaikin money flow is continuing to turn a little bit more positive. So that's looking better as well. We ticked down with the Chaikin oscillator, but we're still above zero. So that continues to be positive. We're going up with our cumulative NYSE advanced decline line, and our regular advanced decline line actually ticked down just a little bit. This other NYSE advanced decline line also ticked, but not a real big move. When we look at common stock in the NYSE based on price, we ticked down a little bit, where we're still going up based on volume. That's a little bit of a positive divergence there. When we look at the cumulative S&P advanced decline line based on price, that's continuing to go up. We're still seeing a bit of a lag when we look at this based on volume. The advanced decline lines still holding up across the different indexes that we follow, not seeing any real strength, but not seeing any weakness either. Here's our short-term chart. We're still above this pivot point here, and we've been able to hang on to that. Now, that's probably going to change. We're either going to break up and go above this, or we're going to fall down below it. We're still above the 50-day moving average, but you can see volume continues to be well below average. But in the short term, our Stochh RSI, the Williams percent R, the CCI 14 and 20 continue to be extreme positive. And there should be a stochastics chart in here somewhere, but maybe it should be right here. We will be keeping an eye on the 20-period simple and exponential moving averages. This is short term, and they continue to show an improvement. Take my word for it. If we don't see a stochastics chart, we're extreme in the short, intermediate, and starting to get that way in the long term. Here's the double and triple exponential moving average based on 20 periods. We're above the lines, and the lines are starting to go up. And it would be more positive if we could see the blue line start to cross above the green line, because that's the triple, and that moves faster. The moving averages rolled over a bit with the 20, 50, and we're still going up slightly with the 200. The force index did decline, but it's still positive. Oh, here's the stochastics. I got it in the wrong spot. So let's see if I was right. So looking extreme in the short, intermediate, and starting to get extreme in the long term. So I did get that right. That's kind of surprising. And we're still in the +2 channel with our standard deviations. It's when we get up into the +3, that's when it starts to look extreme. Intermediate term, the balance of power did decline, but it's still positive. The go, no go, it looks like it's turning from brown, and we see some light blue here. It might be starting to switch over and actually look positive. The highest high value still is going up, and we're above the midpoint, and the midpoint is going up. The TTM squeeze is still going up, and we're getting kind of close to this black line here. But I put this here. It's just kind of an eyeball thing that I do. There are times when we can go well above this black line if that ends up being what happens. Looking at our double and triple exponential moving average based on 50 periods, we're still above both lines. They're both turning up. It would look even more positive if the red line could get back above the blue line. Here's the CMB composite. It's just screaming up. Why? I mean, we weren't really doing all that much, but hey, that's how some of these indicators work. The 50-period moving average, we're still above that. It would be even more positive if the blue line could come back above the red line. But as long as we stay above this, that suggests the intermediate term is switching back to positive. The ease of movement did decline, but we're still above zero. The Erin was flat, but we finally saw some movement after Friday's session where we turned positive with this indicator. We are no longer extreme positive with the McClellan oscillator for the S&P. It came down from that extreme reading, but we're still going up with the summation index based on price and volume. We turned down, but we're still positive with the NYSE McClellan oscillator, but we're still going up with the summation index based on price and volume for the NYSE. This is a warning sign. We're now seeing this for a couple of days. It started to roll over after Friday, and now it's rolling over again after Monday. We're positive with the Swenlin trading oscillator, but we're turning down based on price and volume. Our momentum is still positive, both with the PMO. When we look at the PMO just based on price and volume, those are looking positive. We're coming down. We almost got extreme with the PMOs that are rising. The buy signals ticking down just a little bit, and we're flattening out with the PMOs that are above zero. We've switched over to neutral with the Elder's Impulse system for the S&P. We're positive with the parabolic SAR. And if you didn't watch the weekly video, we now see a dot underneath after last week. So we have a positive daily chart and now a positive weekly chart, according to the parabolic SAR. Here's the slope oscillator. We're getting above this green line. Again, I put this green line on here. I just use it for reference. The MACD is still looking positive. All of our oscillators in the short, intermediate, and long term continue to look positive. They're crossing back above their moving averages and going up. We'll be watching this whole spaghetti mess here with our moving averages. The longer we can stay above it, the more the shorter term moving averages may turn and continue to go up. The bullish percent index continues to advance. Maybe that blip up that we saw right at the open helped kick this into gear a little bit. So that's positive. We're going up with the NYSE bullish percent index. And this is positive now. We've crossed above 50 with the NASDAQ 100 bullish percent index. Over the weekend, this was a warning sign. It looked like the NASDAQ 100 was lagging, and it could go back to that. But for right now, we saw enough upward thrust so that some point and figure buy signals were generated enough to cross back above 50. The money flow declined, but it's still above 50. That's positive. After being extreme, the ultimate oscillator is now dropping down. That's still positive. The vortex declined, but it's still positive with the green line on top. We're still seeing an improvement with the RSI 14 and the RSI 9. They're getting above 50. We're still above the moving average with on-balance volume, even though we ticked down slightly. We turned down with our 20-period moving averages inside of the S&P 500, but we are showing an improvement here. And here's the study. After getting a really extreme negative reading below 10, we saw enough of a thrust to get above 70, which when that happened a year ago, good things ended up happening after that. We saw a failed attempt here, but we never got up to 70 with this one that happened in October. But that was met with a positive divergence, and then we saw one right after that, and then this was the big run-up that we saw going into the end of 2023 and into 2024. Stocks above their 50-day moving averages, above 50 and going up. That's positive. Turning down a little bit with the 100 and still kind of flattening out here with the stocks above their 200-day moving averages. The Copic curve is positive. The Sean trend meter's up in this initial extreme positive area. It really gets extreme if we go up into this darker green area. And I have another new chart after this. I'm going to try something. I've been studying this for a while now, and I want to release it here in the video. This is just a plain vanilla, I don't know if there's such a thing as a plain vanilla Ichimoku cloud because there's all different colors. We use this mostly for support or resistance, but you can also use this to do some deeper studies. We're still coming out of the upside of this cloud. So on this next chart, this is a shorter term look at that same Ichimoku cloud. What I want to start pointing out are the different lines that we see here. There's the ones that are most important that we watch on a day in and day out basis are the blue line and the red line. When the blue line's above the red line, we're going up. Well, as we were pulling back, we saw the blue line drop down below the red line. Now it's starting to cross back above. So this is turning more positive. This is a little bit longer term, this green line here, and we probably won't pay as much of attention to that because it really lags. It's actually way back here. Well, no, I guess it keeps on going. It's just kind of hard to see with all these lines. That's why I didn't use the full study for this for so long, because it's like, okay, how many lines can you draw on one chart and still have it make sense? Well, I'm going to try to use this and see if that provides some additional insight. But this is just confirming what we're seeing with our other charts. The standard deviation is still going up, meaning that we've been going up pretty fast. The Pring bottom fisher did generate a signal back in late April. That's still effective. We also have what I'm taking right now as a negative signal with the mass index. We dropped down below this red dashed line. We're continuing to fall. Whatever happened to trigger this signal, and we were going up, the mass index is anticipating a reversal. So this could go to the bearish side of things, that the economic reports coming out are just going to tank the market from here. But this is really the only thing we're seeing now. We're not seeing any other confirmation, really. And then our different charts, looking at the Heiken Ashi, were positive. The Kagi, the Renko, and the three-line break continue to be positive. And then this one, we're still above this R1 level here. And we're staying above that. If we really start to scream to the downside, we'll be watching that 5110 to 5111 level. And then looking at our longer term moving averages, we're still above this red line, which you could probably take for the time being as just being good longer term momentum. Now I have a new chart. I watched some perma bear videos over the weekend, and my goodness, the gentleman took 35 minutes to explain something that he could have explained in 15 seconds. But you know how I've been using the NASDAQ to Dow ratio chart? Okay. I got that idea from the gentleman that does these videos. Well, he has another one, semiconductors using the SOX index also to the Dow, where it hit a really, and you can't really see this because of the labeling here, but this hit the high back in 2000. That's when we had the dot-com boom, and then after the dot-com bust, because semiconductors are a huge part of the tech sector. We came back up and we hit this blue line again, and now we're starting to come back down. Now, are we going to continue to fall, or are we going to turn and be able to go back up? We don't know that. Now, the person making the video, they are convinced that the end of the world is coming, and any day now. But we just watch this with a more sober look, just saying, okay, when this is going up, yeah, it could fall apart, and we'll watch this. But for right now, yeah, it's coming down a little bit, but it doesn't mean the end of the world. Also, the same person was fiddling around with cycles. And you notice I dropped that one cycle chart that I had been showing earlier in the video. I just couldn't take that. And there's no updates anymore. And so I just didn't want to do that. But he was coming up with this 197-day cycle. I mean, I like fooling around with charts and indicators and stuff, but who fools around and tries, let's try 183, let's try 216, let's try. It's like, oh my gosh, that's just not my kind of thing. Actually, we hit this 197-day cycle as of Friday. And so now the end of the world should be coming right now. And if you go back, there might be some validity to this. We hit a high back in 2023 that ended up marking the high when you use the 197 cycle. We also hit a low back in late 2022. That was pretty much the bottom that we hit. And then we hit another high right at early 2022. I don't know if I'd put as much weight going back, because this is when we hit the all-time high, and then this is what we've been dealing with since that time. But, you know, you can even line up some of these along the way. So we'll just keep an eye on this and just use it as part of our information sources. The indexes, we are positive with the Keller market model across the board. We are still negative based on price with bonds in the intermediate and long term. We've switched back to up with the commodities in the short term. We're still going down with the dollar in the short term. No changes with the decision point scorecard. We had all blue or green in Monday's session. Financial sector had a BPI, it went above 80. And we had a BPI for the NASDAQ. The utilities, this is another concern, and I have some charts later to show you. This, in a theoretical sense, should not be happening right now. Utilities would typically be going down. The fact that they're going up is causing us some concern because we're not exactly sure why. But they set another, this is the third day now, they set a new 52-week high. But the tech sector, that's what it kind of matches up with the NASDAQ 100. We crossed above 50 with the bullish percent index, and then the NASDAQ got above 16.4. Here are the sectors just for Monday's session. Tech was up. Real estate was up again. Of course, it could be at the bottom tomorrow. And then utilities. They were unchanged on the day, but they did set a new intraday 52-week high. And then all the other sectors ended up being down on the day. The equal weight still kind of hanging in there when compared to the S&P. We didn't see any change with our ratio, and this has really been chopping around for most of 2024. The Dow did decline, but it's still above this R1 level here and still above its 50-day moving average. The diamonds have switched from being positive over to neutral now. The NASDAQ is still dancing along this R1 pivot level. Those tend to be important for the NASDAQ. And we're still underneath this R1 level for the NASDAQ 100, which these pivot levels tend to be important as well. We've switched over to neutral with the QQQs for the Elders Impulse system. The momentum for the NASDAQ 100 is still positive, and we're still above all the moving averages that are plotted here. The longer we can stay above this, the more the blue line may turn and cross back above the red line. And we're just getting up into the higher end of the range with the small caps. We continue to be neutral with the small caps when looking at the Elders Impulse system. We're still above the 50-day moving average with the Russell 2000 small caps. We're still above 50 with the RSI. The longer-term trend is still positive, and the momentum continues to be positive. Mid caps did fall just a little bit below this pivot level, this R1 level. It had been, well, it never really closed above it. It was using it as overhead resistance, and it's still acting as resistance. And we switched over to neutral for the Elders Impulse system with the mid caps. Apple was up 1.76% and above its moving average, the 200-day moving average, but it's still in a downtrend. Tesla was down, it was up 2% and now trying to come back up to its 50-day moving average, but also in a downtrend. And Nvidia was up a little over 0.5%, also a little bit above its 50-day moving average. Microsoft still having a little bit of trouble getting above its 50-day moving average. Meta was down 1.72%. And then Amazon was down 0.5%, but above its 50-day moving average. And Google was up 0.29%, also above its 50-day moving average. I saw an interesting cartoon over the weekend that I was going to show. It says Magnificent 7, and then it crosses it out, and then says 6, and then that's crossed out, and then 5 crossed out. They've got it down to 4 now. Here's the FANG index, which has really been chopping sideways. It was up 0.5%, but it's not really breaking out. However, it's still positive because it's above its 50-day moving average, and its longer-term trend is positive. And we're still looking okay here with the financial sector. Even though we declined, we're above the 50-day moving average and still in an uptrend. This is another area we've been watching. We want to see this ratio go down, meaning that staples are underperforming tech. It started to spike back up. It was coming down, and now it's kind of bouncing around, indecisive right now. The dollar was down, even though it shows it up slightly here. By the time we closed for stocks, the dollar was down slightly. Looking internationally with the S&P and then the world index that we follow, shorter term, we're having a tendency to go in the same direction. Really no changes happening here with our longer term correlation. And I want to keep showing the staple sector. It was down, but it has been in a really solid uptrend. It went through some weakness, but now has been coming back up. This is another thing that the utilities and the staples really going up. You normally wouldn't really see that in this kind of an environment. These are more defensive types of things. And so that's why we're watching these areas. And then here's the utilities, which were unchanged on the day, but just really moving up solid. And then I wanted to show a longer term version of this chart with some moving averages here, just showing that we have now gone back into an uptrend on the daily chart. And then this is, I don't have any labels on here. This is a weekly chart where we came down. We're still kind of in a longer term downtrend here, but that's probably going to change pretty quick if price stays above both of these moving averages. And then total stocks, they were virtually unchanged and still above their 50-day moving average. Keeping an eye on interest rates, we were down slightly with the 10-year yield. We were up slightly with the 10-year based on price. And then looking at the tech sector and comparing it with bonds, we're starting to just peak a little bit outside of the upper end of that rainbow. We want to see that continue. The Qs also peaking a little bit further outside of the up part of the rainbow. And then looking at our growth to value ratios, nothing really all that happy, I guess, if you're positive on the market here. The Qs to S&P, right on the moving average, declining with discretionary to S&P. We declined with large cap growth versus large cap value. So we're seeing weakness in the large caps, mid caps, and small caps. We need to see all of these ratios turn and start to go up if we're going to be more positive. But we're still looking good here. With the 10-day average of the S&P 500 highs minus the lows, it's continuing to climb. And this is 10 days. And so that's why this can still go up even when we have a down day. We're still looking good here with our 19-day advanced decline ratio based on price and volume. We're still looking positive with our 5-period moving average of the highs minus the lows across the broad market. This is still a concern. We're seeing this ratio going down. That means utilities are outperforming the S&P. We want to see this turn around and go up to be more positive for the S&P. And we're coming back up slightly with our staples to S&P 500 ratio. We want to see this decline. So what's our outlook for Tuesday? We're still positive with our technicals, and we have to put a question mark. Are we extreme positive, or are we just kind of camping out in extreme positive territory before we get set to go even higher? If we're extreme and looking for a pullback, well, we kind of worked through that pullback that already happened. What's going to happen in the upcoming week? It's probably going to be dictated by the interpretation of the inflation reports coming out. We're going to, on Tuesday anyway, we're going to get the NFIB small business optimism, and then the big one is going to be PPI. And then we want to keep an eye on the geopolitical events. Then in Wednesday, this is getting strange. Usually they have retail sales in one of the CPI or PPI reports on different days. They're both coming out on Wednesday. So the market's getting a double whammy of what it needs to react to. And then on Thursday, that's when we get industrial production and capacity utilization. I think the LEI is important, especially because even though a lot of people don't, because a lot of parts of this report are already known beforehand, but that gives us an idea of what do we look like on a recession basis. And then here is showing that on Tuesday, Fed Chair Powell is going to give a speech. So you're going to have PPI coming out. You're going to have him talking. They're going to be hanging on his every word. So it could be a lot more exciting than Monday was. And then seasonality, we're neutral to positive with the Dow, where we're neutral to negative with the S&P and NASDAQ. We are into options expiration week, where we tend to be we tend to be up less than we are down. I should have went with what I was originally saying. And then we do see some positive seasonality on the 10th trading day of the month. And then this is sometimes where we see some positive seasonality after this during an election year. Tuesday is kind of pretty much unchanged going back to how things acted in 2023, but we're still in that negative window according to Tom Bowley's research. So the warning signs. The Swenlin trading oscillator, it's positive, but it's rolling over. It rolled over a bit after Friday, and it's rolling a bit more over. Is that really how to say it? Rolling over a bit more. After Monday's session, the mass index has now The mass index has now triggered a signal. Since the S&P was going up when that was triggered, this may suggest a reversal. If the S&P makes a new all-time high, with staples and utilities still looking really solid the way they have been, this will be a warning sign as well. And then the long-term ratios, we need to watch those. The new charts that I showed from the Perma Bears, they're just convinced that this is, case closed. We're going down, and we're going down 50, 60, 80, 90%. I don't take that same view. We just watch it unfold one day at a time. You know how many more viewers I would get on my videos if I put scary headlines on there? But I don't play those games. All right. Positive signs. And we have quite a positive list here. The equity put call ratio for the last 5 trading days is still going down. And we have all of our oscillators here. I'm not going to read all these off because I've been just saying them. The one that has changed over is at the bottom. We're not only on a momentum basis for the NASDAQ 100, but the bullish percent index is now crossed above 50. And the financial sector is still looking good there. So our conclusion, we're positive, but we have to wonder, are we becoming an extreme positive? You can make a case for either side. We are positive but extreme in the short term. Now, that's a fact. Where we go from here, we don't know, but we are extreme positive in the short term. We're becoming more extreme positive in the intermediate term. We just don't know what the market's going to do with that. And we're still positive in the long term. So thank you. I really hope you found this helpful. I hope you have a great day, and I will talk to you in the next video.